So, professors, after the theories, that's after you have done what is accounting, the uses of accounting information, blah, 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 you now begin the real accounting, which is recording business transactions. Now, you need to also appreciate a certain principle, that's a double entry principle, which was designed by this Italian monk, Fra Luca Pacioli, right? Luca Pacioli, an Italian monk, but a trade merchant at the same time. So he devised, or he is the brain behind this double entry principle. Now, if you pick his principle, it is straightforward though, but there are certain elements in the principle you need to understand. Okay, and that is the basis for this accounting equation. Because according to Pacioli, every transaction has two effects, two main effects. It's either a positive or negative or positive negative or negative positive. So let me give an example. If you go to the market with money, as in you have money, cash, to go and buy, let's say, fufu. Now, you as the person buying the fufu, you are one entity. And then the chop bar is also another entity. So if you are doing the analysis, you always need to establish which party you are reporting about. So if you are reporting about you, then you need to determine the two effects Luca Pacioli is talking about. So in your case, you went with cash, you gave the cash out, and you got what? Fufu. So the two effects are that you are losing cash and you are getting what? Fufu. So the losing will be minus, the gaining will be plus. So you are gaining fufu, you are losing what? Cash. If we look at it from the point of the chop bar, the chop bar will be losing fufu, but will be gaining what? Cash. So if you really test Pacioli's principle, it is true that every transaction, okay, has these two effects. And he defines a transaction as what? An exchange. An exchange. So in any exchange event, there are two effects. So with this background, then we need to understand that whatever we have in this life as our property or resources did not come from the skies. Okay, we have a source for the properties that we have. So if your father has a land, a car, he has computer phones, the question is, where did he get these items from? And definitely your father will tell you, oh, some of them I bought it myself. Some of them too, I took a loan or I borrowed. Okay. Now, all the things that he has, that's the land, the vehicles, the phones, they are called the assets, the resources. And then where he got it from, if he got it by himself, then that is seen as capital. But those that he got it from other people or he got from loans, he borrowed from other people, those are the liabilities. So let me now shift this into the perspective of a business. So if we take a business like MTN, MTN also has resources, which we call assets. And that includes the building, the land, the vehicles, all the resources they have. The question is, where did they get those resources? Where did MTN get it from? The answer will be that MTN got it from the owners of MTN. And that's the capital or the equity. So capital or equity. So those are the resources that the owners of the business contributed. Then all other resources that are coming from people who are not the owners, that is the liabilities. And so that's how we have the accounting equation as asset equals capital plus liabilities. What it means is that the resources that a business have, the resources that a business has. Okay. The sources of those resources are either from the owners or other people who are not owners. That's what it means, basically. Please, do we appreciate that point?
Yes.
Great. So in events where you see there are some companies, all the resources they have, it came from the owners. They didn't borrow from anybody or they didn't take from any, all of them were coming from the owners. In that case, then we have the equation to be asset equals capital. It means that all the resources were provided by the owners. So when I'm teaching students, I always use the family as a business. If the family is seen as a business, then the father, the mother, the children are the owners. So all the properties the family has, okay, which are assets. If you ask, where did the family get it from? They'll say, oh, from the father, the mother, and the children. So that will be what? Asset equals capital, because those who are funding the resources are the owners, the true members of the family. Now, there are some families, they don't have anything of their own. No. Everything la borrow, everything they borrow is from third people. In that case, then their resources were provided by other people who are not members of the family. And that becomes the asset equals what? Liabilities. Okay, and it can happen like that. But the basic accounting equation is that under normal circumstance, your resources should be a combination of what you, the owners, so you, the family members, what have you invested in the family, and what else are you getting from other people or people who are not owners. And so that is the reason or the rationale behind the accounting equation. If you understand it that way, then the next thing is for you to know the elements of this equation. And the elements are assets, liabilities, capital. And I think last time I added the other two, expenses and revenue. So there are five of them. But the ones you easily see in the equations or the equation is the asset, liability, capital. The income and expense, you don't see it here, but they affect capital. So income and expenses affect what? Capital. Put that point somewhere. We will need it. So there are 5 elements of accounting, but in the accounting equation, you see the main 3. Okay. So now you need to appreciate what is an asset, the examples of asset, the types of assets, which I'm sure you did very well in school. Anna, let me not go there. Let me ask my professors. So professors, what do you know about an asset? You can't asset, what is it? One person should summarize for us all that you know about the asset. Definition, types, examples. Should I call some? Oh, this one volunteer now. Volunteer and let's go. Because of our time, please. Who is volunteer? Prof. Nicole. Okay, I think Fidel is ready. But okay, Fidel, you are ready, so take us through.
Say please, an asset is any resource owned and controlled by a business entity.
Okay. Okay. So is any resource owned and controlled by an entity? Thank you, Prof. Fidel. I'll comment on that definition. But let me hear from more professors. Now, professor, you didn't do, if you didn't do that one too, let me know. But no, I'm sure you did that one. You did it. Prof. Fifi, Emmanuel Fifi Nati. Today I haven't heard from you. Prof. Fifi, what do you know about an asset?
Sir, please. Assets are valuable items owned by a business.
Okay. Okay. Prof. Agbeko, the gentlemen are speaking. I need some female voices. So the females, get ready. Agbeko, let's hear you.
Say please, an asset is a resource that helps in the running of a business.
Okay. Let me hear from the ladies. Stacy, Nicole, and then Mana, Prof. Stacy and Prof. Nicole, you are the only females I can identify. Okay, Christabel is also here. Yeah. So let's hear from you, ladies. Prof. Nicole, let me come to you first. Because, who has the hand up? Okay, Christabel, let's hear you.
For me, an asset is simply the resources needed in a business.
Okay. I want to hear from Nicole because Nicole's question has led us to this point. So, Prof. Nicole.
So please, assets are the total resources of a business,
Mm-hmm.
either supplied by the owners of the business or borrowed from other people.
Okay.
Yes.
Thank you. In fact, all your definitions are correct, but in exams, you would have lost precious point because assets are not just resources that are owned and controlled by a business. Technically, in fact, when you get to the university, you appreciate what I'm about to say now. When you begin to look at the accounting standards, okay, it defines assets as resources. Even before I say, let me ask this question and see what you people will say. So let's say I'm a business, okay. I'm a food vendor, okay. Maybe I sell pizza or something, and then I go and rent a store, right? I go to rent a store in the market for say 10 years. Would you consider that as an asset? I have that store, right? But in fact, all the pizza I do and everything is in my home. And even my customers come home to come and, buy the pizza. So technically that shop there that I have acquired or I have owned, I don't use it. Would you consider that as an asset? Or let's say that same scenario, right? I have a car which I bought to use in the business. So I own the car. I control it. Okay. But the car is parked. My customers come to the shop to buy. So I don't even use it for any delivery or anything. Would you consider the car as my asset? Accounting is sweet, but a little complex. Because I own and control it. So per your definition, is an asset, right? Yes, Amuzu.
There may be that since you own it, it may still be your asset.
Okay. So I asked that to tell you that, you see, the fact that you own and control a resource does not make it an asset. According to the accounting standards, assets should be resources that generate benefits or revenue or income to a business. If not, it cannot be considered as an asset. So you might own it, you might be controlling, but if it's not bringing any benefit to the business, in accounting, we don't acknowledge that as an asset. So when you are defining assets, after saying that it is a resource that is owned and controlled by a business, you should add that economic benefits flow to the business from this resource. Okay. Or you can say used to generate income or revenue. That makes it an asset. So learn this from me today, right? When you get to the university, or those who would attempt the professional courses, ICAG, and then ACC, you appreciate it. The standards define asset as a resource out of which future economic benefits flow to the business. Okay. So there are some assets, when you check the control and ownership, the business does not have full control or ownership, but they are generating income or benefit from it. So they still consider it as an asset. Okay. So that is just by the way. So examples of assets, I'm sure you can tell me plenty: land, building, cash, stock of goods or inventory, debtors, okay, all those things. Very well. But they are divided into two types: the current and the non-current. I think you remember all these theories, right? So I have this, I think I may have to share these notes with you. So my definition of asset, as you see here, they are resources owned and controlled by a business arising from past events which has future benefits. That's very key. Simply, assets are properties of a business. Okay. Types of assets. So we have the fixed assets or the non-current. And even the non-current or fixed, we have grouped them into tangible and what? Intangible. Tangible and intangible. I think you did all this in school, right? My professors, I hope you did that in school. Yes or no?
Yes, sir.
Okay.
Yes, sir.
Okay. So you see something like copyright. How many of us know copyright or know things about copyright? Okay. So copyright, goodwill, patent, trademark, all these things are assets, okay, but they don't have a physical form. You can't see copyright, you can't see trademark, you can't see patent, okay. You can't see, well, I'm yet to see a student who will say he can see goodwill and copyright, or touch and feel them. Because comparable to building, plant and machines, this one you can see, you can touch them, you can feel them. Okay, but copyright. Now copyright is mostly used in the music industry, and then those into writing of books, stories, movies. Okay, so it is a protection against people copying your material without acknowledging you. Okay, I think recently you heard the story about this. Is it this music group, Team Eternity? Meshia Nyamianka, Wayemi Defe Defe. And one musician was saying that thing is for him, so they need to acknowledge. It became a court issue and all that. So why is copyright an asset? It's an asset because that protection on your property or your resource does not allow people to just copy it and sell it for their personal gain. They would have to see you before. So those who write textbooks, they have this copyright protection. So if you want to make copies and sell, you have to see them. So because of that protection, you see them negotiate and they will get some money, some benefit from it. That's why it is what, an asset. Because of the copyright businesses have, people cannot copy it. You need to go to them to buy the resource or the item from the goods or the services they are rendering from them, right? Nobody here can, imitate some companies like you produce the same Coca-Cola with the labels, everything. They'll catch you now, court case. They'll fine you plenty. And then something like trademark. You see now when people are going to buy laptops, vehicles, they check for some mark. They want to see some mark, even shoes. When you see the mark, it tells you, oh, this is from Nike, this is Adidas. So you see that mark, that unique symbol is helping the business to generate revenue because customers want to buy Apple. So if they see the laptop, they have to see that Apple symbol there. So you see, because of that symbol, customers are buying that particular item. So the business is getting more revenue. This is why some of these things. And then goodwill simply means the good name. In simple terms, the good name the business has, as in the business is popular. But the popularity comes because probably the business is doing good things like quality products, good customer care. Okay. And the goodwill is making them generate more money. Now, if I talk about the best telecommunication network in this country, I think all of us will shift to MTN. Say, oh, MTN, everywhere you go, MTN. Compared to something like, are they even in the system? Is it Kasapa or Espresso? I think they are dead and gone. Now it's MTN, Telecel, and the others. I don't even know them. Okay. So these are the fixed assets, and I think you explored that. Now the current assets. Please, when you are defining current assets, be very careful, because some say they are assets that are consumed within one financial year. But the question is, you can have some current assets which will go beyond 1 year. So imagine somebody has a shop, he sells shoes, then he goes and brings the shoe. The shoe is seen as stock, which is a current asset, the stock of goods, right? But does it finish in 1 year? No. Some shoes can even stay in the shop for 3 years, 4 years. So it is a current asset because reasonably they are expected to convert into cash. So reasonably they are expected to convert into cash, but it's not always the case that they convert into cash within 1 year. Okay. So watch out and be using the technical definitions. Okay. So some say, oh, it's an asset that lasts in the business for 1 year. That lasts, but somebody has cash in his bank account that's lasted for more than 1 year. So would you still say it's a current asset? So then when you are defining it, you say these are assets that are reasonably expected to be converted into cash within one financial year. So they are expected to be converted. It doesn't mean that they are by force supposed to be converted into cash. Okay. You have the examples of current assets. The stock is one of them, or inventory. Debtors, which is also known as account receivables. Then you have the money you have in your bank account, the cash. And then we have expenses prepaid. Expenses prepaid. Please, do you understand this expense prepaid? Whoever understands it should share with us. Expenses prepaid. Expenses prepaid. Okay. So when we say prepayment, it means that like the electricity, see that this time you make payment for the electricity even before you use it. Okay. Another one is rent. Sometimes we pay for 5 years rent advance. So prepayment is also known as advance payment. You are paying beyond the current year. So it's your asset. If you go to rent somebody's building today and you pay for 5 years, you have not used the building for that next 5 years. So it's still your money. You can go and claim that, oh, please, I rented and if I'm sick, so it's your resource, which you can easily convert into cash within one financial year. Okay, so that's expenses prepaid. When you make advance payment for expenses you have not incurred. Okay, so like you go and pay for rent, you haven't used the building. I think when we're in JHS, we're doing some of these things. Our parents will pay our school fees in advance. Accrued income, that's the opposite of or not the opposite of expense prepaid, but accrued income means that you are supposed to receive some money, but it has not been paid to you. So let's say a business, you sell goods to your customers, they are supposed to pay you, they haven't paid. That's an accrued income. Or you have made an investment in a bank deposit or fixed deposit or treasury bill, and your interests have not been paid to you. Or this one, I know it's not a good example, but let me use it. You made an investment in Men's Gold, and you were supposed to receive an interest, and Men's Gold hasn't paid. So that becomes an accrued income, an income that you are expecting to receive. So it's in arrears. Okay. Then you come to the liabilities. So definition of liabilities, these are obligations or the debts, the debt of the business, right? Settlement of which leads to outflow. In fact, the definitions I put in this note are the standard definitions. Okay. Then types of liabilities, we have the current, and the long-term liabilities. And I think you know that one too as well. Then we come to capital, which is what the owner has invested in the businesses. So you need to appreciate these element examples, and then you can manipulate the accounting equation. I know you did all that. Then we now come to the effects of transactions on the accounting equation. I'll just give a brief statement and then I think we'll end the class. Because some professors are saying, Mr. Amwaden and I say, oh, confuse you. Please, I hope I'm not confusing you. Or let me pause for you to
No,
ask.
sir.
Let me pause for you to ask few questions. But I'm trying to give you simple understanding of some of the concepts so that at least you can get things in perspective before we look at this. So business transactions, what are business transactions? Okay, we are saying events that you can measure in monetary terms. So examples, you sell goods, you purchase goods, you go for a loan, you buy a land, you buy a vehicle. All these are business transactions because you can measure them in money terms. If they ask you, you said you have sold goods, how much? You can tell that, oh, I sold for 5,000. So there is a monetary factor in there, making it a business transaction. So we are saying that when these things happen, they affect the asset, the liabilities, and what? Capital of the business. It can increase it or decrease it, depending on the transaction that is happening. Okay, so I always take my student through 10 basic transactions. 10. And trust me, if you get these 10 basic transactions, no accounting transaction should make you, suffer. You'll be very much okay with it. So I will take you through these 10 basic transactions, how each of them affects the accounting equation as in the asset, liabilities, and what? Capital. So for example, but I think I can ask you a few things. Let's say you are in a family. The family is a business. And then the family takes cash to go and buy land. The issue is, what is happening? The family has taken cash to go and buy land. Now, this cash and land, we have learned that they are assets or resources. So if the business has taken cash to go and buy land, then what is happening? What is increasing and what is decreasing? We can tell that, okay, the business is losing the cash. The cash is going out of the family, the business, right? So cash as an asset is decreasing. But again, the business is getting another asset, which is land. That one is coming into the family, the business. So we can say land is what? Increasing, an asset that is increasing. So for this transaction of you taking cash to buy land, the effect will be increase in one asset, land, and decrease in another asset, cash. So that is how you make the analysis to know these effects. But like I said, I'll take us through 10 basic transactions. And after that, I think you should be able to know whether to debit or credit this or that. So I'll pause here for questions. If there are no questions, I think we'll draw the curtains for today's class. And then we'll continue, God willing, Thursday. So any question, please feel free to ask me questions. Two things are involved, like basket map or they say. It's either I have confused you or I've been able to at least make you understand something small. So which
you have been able to make us understand something small under the transactions, the increase and then the decrease.
So you see, you can do this for yourself. Just you can Google or you can use AI to look at examples of transactions, and then you try to assess. Now, the first thing you can do to help yourself is when the transaction occurs, check to fish out or identify whether there is an asset or liability or capital. Okay, based on the definitions you have on what an asset is, what capital is, and what a liability is. So, for example, if we say the business went for a loan, 5 million cash, you do the analysis. The business went for a loan, 5 million cash. We know that a loan is an obligation that you have to pay back or settle. So the loan is a liability. But we also got money. So it is loan, liability, and then the money, cash, asset. So anytime a business is going for a loan, the two elements are liability, loan, and then asset, what? Cash. If the business is going to buy a land, we know that land is an asset. The business is going to buy land and maybe they paid cash. So again, we have cash, asset, and cash, what? Land. So try to fish out the element. When you know the element, then you now think about whether it is increasing or what? Decreasing. Okay. But like I told you, I'll share the 10 transactions. I think they are here. Oh, they are not any big expense transactions. Yeah. The first one is when the owner makes investment or when the owner starts business. Okay. The second one is when there is let me go down, go down, down. I think the second one is acquisition of an asset, when the business is going to buy an asset, which can be land, building, vehicle, machines. Okay, we'll look at that nature of transaction and what it does to the accounting equation. Then we look at the third one, which is I think sale of goods. When the business sells goods, sale of goods, whether they sell it on credit or they took cash or check. Then the fourth one is purchase of goods, when the business is purchasing goods. Okay. Then I think the next one will be after the purchase of goods, we have acquisition of a loan. When the business is going for loan, what happens to our asset, capital, and liabilities? And then settlement of a liability, when the business is paying off a debt, what happens? And payment of expenses, salaries, wages, all those things. So we'll look at these transactions. Receipt of an income, when the business is receiving income, like when MTN is getting money from its customers, and what happens to the asset. Then return outwards of goods and return inwards of what? Goods. And I think there's an 11th one. That is when the owner takes something for personal use, drawings. So professors, when you go through these 11 transactions, I can tell you from the bosom of my stomach, I won't say heart, that no transaction would appear to be difficult, because all the transactions that will be given to you is either the business is going for a loan, or the business is settling a liability, whether a creditor or another loan, or is buying an asset, or is doing purchase of goods, or is so. Don't worry, we'll go through these 11 transactions and I think we are going to be very okay. But since I've given you a hint, you can also say something small about it. So Prof. Nicole, I want to believe now you are beginning to come back to planet Earth. It seems you were flying on the moon some few moments ago. Or you are still not back? You are still on the moon?
So I'm getting the understanding.
Okay, so small, don't worry. By the time we exhaust the 11 transactions, you would be very okay. And all the things we have been saying would make sense. Okay, please, any question from any professor? Gabriel, Jaden, Josiah, Justice, Fifi, Nate, Dennis, Liv Hayfon. Hey, Dennis, the unpackers are crowd. No ideas, no tea. David, Christabel, and then Ben Eliha. I think I'm seeing Ben Eliha for the first time. Prof. Ben, can you introduce yourself? At least we are wrapping up, so you can, in a minute, tell us. Unless you are a parent, then fine. Okay. So, profs, I think we'll end the class here. Yes, somebody wants to say something. Please go ahead. That's Joris.
Okay.
Yes.
It's like most of the class are doing something about tests and those stuff. I wanted to ask if you'll be doing that anytime soon.
Please take the point again. I didn't hear you.
It seems like most of the classes are doing tests and stuff. I wanted to know about our own when we'll be doing higher any soon.
As did you say test?
Yes, please.
Okay, as in when I think on the scheme of work we should have our first class test. I think it was supposed to be this week, right? But I think I'll shift to next week. So maybe after Thursday's class, we might have gotten some understanding of this double entry, and we'll do our test. I'm looking at whether having it online, where you click on a link, you answer the questions, you submit automatically, you'll get your marks. You take a screenshot and then you put it on your private page. Or maybe I'll go the normal orthodox way. I'll give you a file which has maybe 40 objectives and few subjective questions. You answer and submit. So I'm looking at those two. Okay, thank you for that. Any other comments? Okay, no other comments. Okay, so professors, thank you very much for making it up for today's class. We continue, God willing, tomorrow. Please go and read something small around this double entry and the 10 transactions I have hinted you about, so that Thursday at least you can ask more questions. Do have a great day, and I wish you all the best. See you on Thursday. Bye bye.
Bye bye, say bye bye.
See ya.